Hey, how you doing? And welcome to Livewise, Views from the Top, our newest series dedicated to sharing the ideas and insights of the country's top fund managers. Today, we're very lucky to be joined by Lazard Asset Management's Warryn Robertson. Warryn's going to be sharing some of his top ideas today, as well as his tips for navigating today's very volatile market environment. Thank you so much for joining us today, Warryn. Really excited for this conversation.
Always good to be here.
You have quite an interesting backstory to what influenced you to follow this path into investment management. I was wondering if you could please share that with our viewers today.
Sure. So mum and dad essentially were trusting of an insurance salesman that they shouldn't have been. He manipulated policies that they took out to his own ends and not to theirs. And essentially they were putting $100 in and 20 of it was going to them, 60 was going to him and 20 was going to the policy owners of National Mutual at the time. So it meant they were, they had a change of accountant. People figured out that this wasn't right, that this wasn't a real investment proposition that they were investing in, and they needed to get that solved. And so they brought another independent financial planner in. He worked with mum and dad. Dad went on Current Affairs, 7:30 Report, a few other things, and they eventually got their money back, but it was a long, arduous task. And I think the learnings for me were, Dad's a motor mechanic, Mum would describe herself as a housewife, and they weren't financially astute. And understanding that at the time when I was 12, 13, I think was a big influence on my life in terms of why I wanted to become financially literate and why I wanted to really get into financial markets.
From a previous interview, I remember you telling me you actually interned with your parents' second financial advisor, who actually helped them, didn't rob them of their money. What were some of the key learnings that you took away from that time, and how has your investment philosophy changed over the past 3 decades since then?
Yeah, so Michael Rafferty was his name, lovely guy. He was old-fashioned financial planner. So, find good managers to put money with, invest with those managers, have a diversified portfolio and the like. And what Michael then got me to do was to go and sit in on a presentation by a guy who was young up-and-comer at the time at BT. His name was Kerr Nielsen. And I thought, that's the job I want. And so I worked my way into funds management and that, actually making the investment decisions as opposed to allocating where the money went, to actually say, I want to buy this company, I want to own a piece of this business. It was really something that really attracted me more than being a financial planner, if you like.
Have there been any pivotal moments during those 3 decades in investment management that have really shaped the way you think about investing today?
Yeah, the most instructional learning I had was essentially we all spend our time trying to solve problems. And what smart people do, or what smart people think they try and do, is solve really hard problems. And that becomes really difficult, and sometimes you get it right, sometimes you get it wrong. I think the key learning I've had is that if you're a relatively smart person and you're trying to solve really simple problems, you're more likely to get it right. Now, what does that mean for investing? I try and find businesses that are really easy to understand, easy to forecast their earnings of, easy to put a valuation on, because all I do all day is forecast earnings and put a multiple on it, or forecast a set of cash flows and put a discount rate on it to come up with a value. If you can find a group of businesses that are easier to forecast, therefore easier to value, you're more likely to get it right. So I like to think of what I do is, a relatively smart-ish person, not genius, but certainly okay, trying to solve simple problems, and therefore I'm more likely to get them right. I think that's the key learning, over the 30 years. Don't try and solve the tough problems. They're much too difficult to solve. Solve the easy ones, and you're more likely to get them right.
Okay, I absolutely love that. We actually recently surveyed our readers, and they said that infrastructure was an area of the market they really wanted to learn about. You are a portfolio manager, equity analyst in this area, as well as global equities. Why is infrastructure such an interesting area of the market today?
What people want from infrastructure is that predictability, that simple investment story that translates into predictable earnings over long periods of time. So I think the definition of infrastructure is really important. You need it to be monopolistic. It needs to be able to have protected revenue streams with inflation protected attributes, all those sort of nice, real surety, makes you feel safe. And I think the reason why it's important to have it in a client's portfolio is typically you've got equities which have got a lot of risk to them. They may not work. You've got bonds, that's kind of boring. Something that sits in the middle is where infrastructure is. So it's boring-like, but it can give you that equity-like sort of returns in terms of performance. And if you think about a toll road, it's the simplest way to understand it, right? Every time you use the toll road, your tolls go up by every year. And the more people that use the toll road, the more money they make. So it's a really simple asset that just grows because there's more people that use it, and it has the additional benefit of being able to price at what they like, essentially within reason, to use what is a pretty reasonable benefit.
Over the last few years, listed property and infrastructure assets have really struggled, firstly thanks to COVID-19 lockdowns and then because of rising interest rates. How have your portfolio companies been impacted?
Yeah, I mean, different companies in different ways, as you say. So if you're running a regulated utility that essentially has people locked into their electricity, their gas and their water, their earnings didn't get moved around a lot. If you ran a toll road, the example I gave earlier, well, people, toll roads work really well when you go about your daily lives. We didn't get to go about our daily lives. So everyone stayed at home. The lockdowns really did impact those companies in the short term. Does it make a difference in the long run? And we think that you'll see a return to the office over time. We'll get back there, but it does take a little hole out of those earnings for toll roads and for airports more so. But that created the opportunity. The share prices move up and down a lot more than what the valuations do. And that's what creates the opportunity and what keeps you excited. You're solving simple problems, but if those problems give you an opportunity to make real money, then you embrace it with both hands.
What kind of attributes do you look out for when investing in these types of companies?
Monopolistic, inflation-protected revenue streams, high margins, manageable debt portfolios. And because when you think of the first three, I own a monopoly that gets really good pricing and earns high margins. People love to put lots of debt into it. So you've got to make, the greatest business in the world makes a poor investment. Firstly, if you pay the wrong price for it, or secondly, if you put too much debt in it, it blows up. So, they're the things you've really got to keep in mind and to understand it. And but if you can find those key attributes, they're the types of businesses that, frankly, you want to own forever.
How about the kinds of businesses that you don't want to own?
So, you don't want to invest in in the infrastructure space, merchant power generators who are essentially leveraged to commodity prices. Okay, they're really volatile. So if gas price goes up or down because the Russians decide to invade Ukraine, or Qatar expands its gas supply, or coal moves up and down, those earnings are really volatile. They tend to have high fixed cost structures. There's a lot of people that it takes to run those types of assets, and their margins are much thinner. Now, that doesn't mean at certain times you'll be able to buy them on the cheap, but they're not going to give you that long run investment profile that you want. And that's the key. It's about determining what are the types of assets I want to own in the long run. And then the second step is, what's the right price to pay for them? Because if you pay the right price, you'll do really well. But if you pay the wrong price, safe investment doesn't make a good investment return if you pay the wrong price for it.
Where are you finding those kinds of opportunities where it has that long-term, run, but also they're trading at attractive prices?
Yeah, I mean, it's tough. Even with interest rates moving up, and that's been a headwind for infrastructure, there's some stocks that do better in that environment than others. So if you've got inflation linked and inflation's going up, your revenues are linked to inflation, that doesn't mean you get hurt as much as someone that doesn't have inflation linked revenues. So in terms of countries, we're finding the geographies and countries within Europe are more attractive. The UK in particular is quite an attractive place to put capital today, whereas the United States is still not quite there yet. And it's a technicality around the way they make money, but the simple way to think about it is a US utility doesn't have guaranteed inflation pass-through, whereas a utility in Europe or in the UK does. And that nuance, that subtle difference, makes such a difference in these really difficult times.
Is it possible you could take us through a few examples?
Yeah, sure. So, we really like National Grid, which is the monopoly transmission, electricity and gas grid of the United Kingdom. They also have some assets in the United States, but it's the UK business that we really like. Snam and Turner, their Snam REIT Gas is the monopoly gas transmission network of Italy. Turner is the big poles and power lines of Italy as well. Really good, high quality businesses that earn great returns. In fact, they get a really nice trick they play. Essentially, they get a return on an Italian bond yield that's based around their regulatory regime. But because they're monopolistic assets in Europe, they get to borrow off the European Central Bank's balance sheet. So they have a low cost of debt, but a nice attractive regulatory return. They're the ones that we really do like. In terms of companies that we're cautious around, Canadian gas pipelines, the big pipelines in Canada, where they're moving tar sands and the like, little less around the long-term story around those. We're a little cautious. And also just around US utilities, we don't see valuation in that sector at this moment.
I want to talk about performance. The fund's performance objective is CPI plus 5%. Mm-hmm. Is that achievable in this inflationary environment?
So firstly, it's CPI plus 5 over rolling 5-year periods. The second thing is, so it doesn't mean we're promising to do 67.5 bips every month, okay? And what it's trying to do is to make people understand, so when we started our strategy out 18 years ago, there was nobody else that did this. There was no one that was offering listed infrastructure available for investors to invest their money with. And what we had to do was just set expectations. And so CPI plus 5, if you think in the long run CPI comes back to 2-3%, it's sort of 7-8% return. And if you think bonds should be giving you 5, equity's giving you 10, then that sits in the middle. And the point was to sort of position it on a risk profile in the middle. To give people a sense of, okay, if I'm tactically allocating to various assets, where should I think about infrastructure? But for our stocks at the moment, even that with the hurdle that it has, we've got a concentrated portfolio of names, and we think we can still achieve out of the portfolio CPI plus 5 and a little bit more at the moment.
Okay, you kind of touched on this earlier about the areas of the market you're avoiding, but are there any crowded areas that you want to call out that could face headwinds over the year ahead?
Yeah, look, in the last 12 to 18 months, we've positioned ourselves out of US utilities into Europe, the UK, and some parts of Australia selectively. I think that in the long run, that trade still has more to go because US utilities, although the price to earnings ratio or PEs look attractive and people go, oh, they're back in line with their decade or 2-decade average. What that fails to recognise for the US utility sector is that they've taken on a lot more debt. And when you think about it, you own equity as an equity shareholder, but there's a whole bunch of debt holders that own a claim to the assets that you get the residual thereafter. So you've got to consider the whole balance sheet. And I remember talking to Rob Maple-Brown many years ago about a stock, and he said, no one ever looks at balance sheets anymore. And the important thing to do today is to definitely look at the balance sheets of US utilities. And we're calling out some particular stocks and sectors in that space where the level of indebtedness is a little too cute for us, and that's what we're worried about. It's going to be when they have to refinance some of that debt, they're going to pay a lot more for it, and we don't think they're going to be compensated with better returns on the other side. So that means equity gets crunched. That's where we're cautious today, particular.
You talked about there being opportunity in Australia. We've obviously seen some private equity / super fund action within infrastructure assets in Australia with Sydney Airport during COVID-19. Do you feel like there's any M&A opportunity within infrastructure over the year ahead?
Oh, it's definitely, it's not as bad as it was bad. It's not as prevalent as it was in 2007-8 when you literally had, if I looked at our 90 odd stocks that we would own at the right price, and there was only about a dozen or less that were really quite attractive and really quite cheap. And what did they all have in common? They couldn't get bought out by private equity. Now, it's not quite that bad now, but there is still private equity sitting out there as sort of the put option, if you like, on the whole sector. There's a lot of money being raised. They're chasing very few assets, and they're prepared to pay prices that are, quite aggressive, have lower return hurdles than what I would want. So that's always sitting out there, and it's an issue that we face in terms of the dearth of opportunities that end up coming our way because they keep chewing away and biting at our sector. But in the long run, if they're going to pay a fair price and a premium, then we're prepared to transact at those prices.
Okay, last question for today. What's something that you've learnt recently that you don't feel like you would have become privy to if it weren't for the position that you're in today? What's your view from the top?
I think probably to go back to that point before, that I think everyone thinks about financial markets in a really complex way, and a lot of people who would probably sit in this chair and be interviewed by you love using jargon and slogans and things that make them feel like they're smarter than somebody else. I think what I've learnt is the real insight is understand what your limitations are, try and solve really simple investment problems. You're more likely to get those right, and that means you're more likely to make a lot of money than trying to solve really difficult investment problems. Like you think about companies like Tesla and you go, what's Elon going to do with our business in 20 years' time? I don't know. That's a really difficult investment problem. I'll stick to boring toll roads and regulated utilities and stuff like that. They are much easier to understand, and therefore I think you are much more likely to make good returns over the longer term.
Well, thank you so much for your time today, Warryn. I really enjoyed this discussion.
Always great to chat with you, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.